Hello, my name is Abboud, CEO of Exponent. We're going to be talking about taxes this morning, and taxes are boring unless we put money on your bottom line. And what we're going to be talking about is business owners that have pass-through entities. For example, an S-Corp. We look at a lot of tax returns. We do future tax returns. We don't do present tax returns. But we look at a lot of opportunity that's being missed, and there seems to be random strategies or random ways that business owners pay themselves. And so we're going to look at two scenarios, A and B. Scenario A, the business owner is taking a salary of $400,000. And there is a K1 for another $200,000. That is the net income in the business, the profit. That gets reported on the 1040. So the total taxable income coming on the 1040 is $600,000. Pretty simple. What's interesting is there is a rule called the 199A deduction. What is that? That is stating for business owners, you get a 20% deduction in taxes based on your net income. And I have my trusty calculator here, but 20% of 200 is $40,000 deduction. So that means, in this case, there's reportable income of $560,000. And if you're in a 40% tax bracket, just for rounding, that's $224,000 in taxes. With a stroke of a pen, we'll see if we can make a difference, because there's no additional dollars involved. We're talking about the same universe of income. What if they paid themselves $150,000 in scenario B instead of $400,000? Well, that would mean that we would have another, what is that, $450,000? $600,000 in total wages. What's interesting now, though, is a 20% deduction on the net income would be $90,000 deduction. So there's reportable income of $510 instead of $560, and at a 40% tax rate, $204,000 in taxes. Would you rather pay $224 in taxes, or would you rather pay $204? There's a $20,000 savings just in how you pay yourself. In addition to this, that I didn't calculate, there is Social Security tax on 147 of the full 400, but Medicare on the double side for business owners is about 6%. So there's another 6% employment taxes on the full 400 here, where the 6% is only on 150 here. So there's additional taxes saved and payroll taxes. So a simple stroke of the pen. There are some limitations and wage restrictions that get complicated here in the 199A, and I think that's why nobody's taking advantage of it. But in our planning, we're data guys. We get to the numbers, and here there's no more money made. There's just more left over for you. And if this is compounded in your wealth plan every year over the remainder of your working years, it can amass for some serious dollars. Appreciate your attention. Thank you.